So Pav, in your day-to-day role, what would you say is the most common question you get asked by our clients?
I would say it'd have to be whether the landlord should purchase a property in their personal name or through a limited company. And there's not really a straightforward answer to that, as there's a number of factors at play as to which is more beneficial for the individual. But generally speaking, the individual is looking to purchase a property as a long-term investment, as a source of income to use to fund their retirement income. So generally speaking, the scenario would be that the individual is a higher rate taxpayer, so their salary income is above over £50,000, for example, and they're looking to purchase the rental property. If they were to do that in their personal name, they'll pay 40% tax on the rental profits, increasing to 42% from April 2027. Mm-hmm. And the mortgage interest payments that you can assess as to whether there's any tax deduction on, you're restricted to just a 20% tax credit, and you can't claim that in full. So if you compare that to a limited company, there will be the annual savings, as instead of paying 42%, they'll pay 19% corporation tax on profits up to £50,000. And those profits can be reduced even further as the mortgage interest payments can be claimed in full. So in that scenario, it wouldn't be the case that the landlord would look to rely on that income as a source of income to fund their day-to-day lifestyle. Right. It would very much be the case that it's a long-term investment, that they want to extract funds here and there where they can, for example, making use of the annual tax-free dividend allowance, which is currently at £500 each year. And then when they have retired, when they're no longer a high rate taxpayer, they could then look to distribute the funds out to them, for example, by paying a dividend. And the dividend tax rates for a basic rate taxpayer are far more favourable than the 40% charge they would have been paying in their personal name each year, as the rate currently stands at what is soon to be 10.75%.
Right, okay. So based on what you've just said then, it is kind of what you want as an individual, whether you want kind of like short-term cash rewards or whether you want long-term investments, on which kind of route that you do wish to go down.
Yes, absolutely, because in the situation, if there was that high rate taxpayer who wanted to purchase a rental property but rely on that rental income and access that rental income for everyday spending, then although there will be initially 19% corporation tax to pay on the profits, if they're then paying the funds out to themselves, they would then have to assess the tax due on a dividend, which the high rate will soon turn to 35.75%. Right. Now, there are ways that you can extract funds by, for example, drawing down the director's loan. However, it's not a sustainable way to rely on that rental income each year. The savings through a limited company can certainly be far more favourable if it is considered as a long-term investment and they don't plan to rely on the income.